All right, let's dig into Nokia's third quarter results for 2025. And it's a really fascinating story. It's a tale of a powerful innovation engine going head-to-head with some pretty tough market realities.
Okay, so let's get right to the heart of it. The entire quarter really boils down to this one central question. If sales are growing at such a fantastic pace, why are the profits getting squeezed? It's a bit of a puzzle, and that's exactly what we're going to piece together right now.
So first up, the good news. And honestly, it's very good. On a comparable basis, Nokia's net sales jumped a really solid 9% year-over-year. This is that big, flashy top-line number that shows the company has some serious momentum behind it. But, and this is a big but, that sales number doesn't tell the whole story. Here's the core of that puzzle I mentioned. The operating margin? It fell to 9.0%. Now that's down from a much healthier 11.2% this time last year. This gap, this is the tension we really need to get our heads around.
Now, before we sound all the alarm bells on those margins, it is absolutely crucial to look at this number. The company still pulled in a healthy 0.4 billion euros in free cash flow. So what does that tell us? It tells us that even with that profitability pressure, the business is still fundamentally strong. So let's look at what's fueling all that cash.
To really understand that success, you have to look at what they're calling their AI and cloud engine. I mean, this is the part of the business that is just absolutely firing on all cylinders right now. And this quote really sums up the whole strategy perfectly. The company's new CEO, Justin Hoddard, he lays it out plain and simple. He sees this AI supercycle as the key driver for demand, and he's positioning Nokia to be a leader. Make no mistake, this isn't some side project, it's the central pillar of their whole growth story.
And here's where that strategy translates directly into numbers. Just look at the network infrastructure division. Optical networks, we're talking about the actual hardware that powers this whole AI and cloud boom, grew an incredible 19%. That number right there, that is the AI supercycle in action.
So who's buying all this high-speed gear? Well, this chart tells that story pretty clearly. AI and cloud customers now make up 14% of all the sales in that key network infrastructure division. This is a huge sign that their pivot to serving those massive data center builders is working exactly as they planned. And this isn't just talk. These are concrete, real-world wins. Their order intake is strong, which means future sales are looking healthy. They're shipping cutting-edge 800G components, they're locking in key data center partnerships, and they're even capturing the #1 market share spot in voice core. This is what execution looks like.
Okay, so we've established that the growth engine is absolutely roaring. That brings us right back to our big question. Let's solve this profit puzzle and figure out why all that fantastic growth didn't quite translate to the bottom line this quarter.
The answer is found right here, in the Mobile Networks division. Now check this out. Sales were actually up a respectable 4%, so they're selling more stuff. But just look at that operating margin. It absolutely collapsed, falling all the way from 5.4% last year to a razor-thin 0.7% now. That dramatic drop is what's dragging down the entire company's profitability.
So why in the world did that margin collapse? Well, it comes down to a business school concept called product mix. Think of it this way. Imagine you own a bakery. If you sell a whole lot of high-margin wedding cakes, your profits are going to be great. But if you sell a ton of low-margin bread loaves, yeah, your total sales might go up, but your overall profitability is going to go down. It's all about the blend of what you're selling.
And that is exactly what Nokia said happened. In their mobile networks division, they basically sold fewer of their high-margin wedding cakes, which in this case is their software, and a lot more of their lower-margin bread loaves, their hardware. The key takeaway is simple. Even though they sold more stuff, the blend of what they sold was just less profitable this quarter.
So, given this pretty clear split between a high-growth AI engine and a profitable but pressured mobile business, how is management navigating this whole situation? Let's take a look at their plan.
First things first, management is holding firm on their outlook for the full year. Yeah, and there was a minor accounting adjustment, but the underlying business forecast hasn't changed. They're still confident they're going to hit their profit targets, which is a pretty strong signal heading into the final quarter. And they are definitely not just standing still. They announced a major win re-entering Vodafone 3's network as a radio supplier, which proves they are still a major force in mobile. At the same time, they're sharpening their focus by scaling back some of their venture fund investments. These are all clear signs of a management team that's executing a really disciplined strategy. So, what's the next big event to watch? You're going to want to circle November 19th on your calendar. That's their Capital Markets Day in New York. This is where everyone will be looking for a much deeper dive into the long-term strategy, not just for growth, but just as importantly, for profitability.
Whew, we've covered a lot of ground. So let's wrap all this up by boiling Nokia's entire quarter down into a few key takeaways.
So to put it all together, Nokia's story this quarter really had 4 key chapters. 1. Strong 9% sales growth. Can't argue with that. 2. This was driven by that AI and cloud engine, which is absolutely booming. 3. Profits got squeezed because of that product mix issue in mobile networks. And 4. Despite that squeeze, management is confident in their yearly goals. It's a company in a really interesting strategic pivot, firing on its new growth engine while trying to optimize its traditional business.
And as always, just a quick reminder, this is all for informational purposes only, and it is definitely not investment advice. All of our analysis is based on information that was public as of October 23, 2025. Thanks for joining us.